Welcome back to today's deep dive. Today, we're taking a hard look at a massive billion-dollar question that is just completely dominating the financial tech space right now. And that is, can machine learning actually predict the stock market, or is it mostly just hype? I mean, it's incredibly easy to find these breathless claims online about algorithms practically printing money. Honestly, sometimes looking for reliable algorithmic trading advice on the internet feels a bit like trying to predict the weather by just glancing out your window. Everyone's got a guess, but very few people actually have the data to back it up. So today, we're going to ground ourselves in a rigorous new statistical finance paper by Alex Chen that strips away all that hype. We're going to look at exactly what happens when you pit simple artificial intelligence models against the daily stock market, using absolutely no future knowledge, no magic tricks, just pure math and historical data.
Okay, let's jump right into our roadmap for this analysis. We've got 6 parts to cover. 1. Predicting the stock market. 2. The same-day setup. 3. Which machine learning wins. 4. The high-accuracy catch. 5. Inside the AI brain. And finally, 6. The bottom line. Let's get to it. Starting off with Section 1, Predicting the stock market. To do this right, the study we're analyzing focuses on the SPY, which is the SPDR S&P 500 ETF. This is a massive, highly liquid representation of the broader U.S. stock market. And we aren't just looking at a few months of data here. This study spans from February 1993 all the way through March 2024. That is over 7,800 trading days.
Now, the goal of this paper is deliberately modest, but it perfectly addresses that popular fantasy of using AI to get rich quick. The core question is this: can a basic AI predict whether today's closing price will be higher or lower than yesterday's closing price using absolutely nothing but this morning's opening price and a couple of days of historical lagged prices? That's the whole setup. You wake up, the market opens, you feed that single opening price into the machine, and it tells you if the day is going to end up or down. Sounds pretty incredible, right? But to test this fairly, we have to establish some completely airtight rules.
That brings us right into Section 2, the same-day setup. Because in financial machine learning, there's one cardinal sin you absolutely have to avoid, and it's called information leakage. That's when your AI secretly gets a sneak peek at the future data it's trying to predict. It makes the accuracy look amazingly high in testing, but then the model fails miserably in the real world. So to prevent this, the researcher used a technique called walk-forward validation. Let me explain why this is so crucial. Instead of just shuffling all 30 years of data together, which, would accidentally teach the AI about major market crashes before they actually happen, walk-forward validation forces the model to experience time exactly like we do. Meaning to predict day 100, the model is only allowed to train on days 1 through 99. Then, to predict day 101, it trains on days 1 through 100. The training window just naturally expands step by step. It's a brilliant, highly rigorous setup that makes this paper so much more trustworthy than your standard, heavily over-optimized backtest.
All right, moving to Section 3. Which machine learning wins? We've got our airtight setup. Now, which AI model actually comes out on top? The study pits a few different AI detectives against each other. We've got heavyweights like XGBoost, Random Forest, and LightGBM, which are complex models based on decision trees, going head-to-head against simpler models like Logistic Regression.
And here is the twist, and honestly, it's a huge one. You might think the most complex AI, like XGBoost, would just completely dominate. But looking at this comparison of directional accuracy over the last 800 trading days, a much simpler model, good old logistic regression, actually blows those complex tree models out of the water. It hit a 71.09% accuracy rate for predicting the close direction. Meanwhile, among the tree models, Random Forest was the strongest at 61.20%, and XGBoost dragged behind at 58.45%. So why did this happen? Well, it's because logistic regression was trained directly on direction labels, meaning it literally only had to predict up or down. The tree models were trying to predict the exact continuous dollar price first, and then figuring out the direction from that. It turns out, if you only care about direction, direct classification is just flat out better.
Now, because XGBoost predicts an actual price, not just a direction, you can actually ask the AI how confident it is based on how big of a price move it expects. And what's really interesting about this next part is what happens when you do that. Let's look at Section 4, the high accuracy catch.
We're going to spend a minute here because this visual is literally the climax of our analysis, and we really need to unpack what's going on. This chart brilliantly illustrates what happens when we filter the AI's predictions by the expected size of the market move. Let's break down the axes. The x-axis along the bottom is the predicted change threshold in percent. The left y-axis, which is tracked by that blue line, is the directional accuracy, and the right y-axis, tracked by those pink bars you see, is the number of samples, meaning how many trading days actually met that specific threshold. Now, follow that blue line from left to right. When the AI predicts a tiny, basically 0% move, its accuracy sits at that baseline 58.4%. But as we demand a higher threshold, so we only look at days where the AI confidently predicts a move of 1%, 2%, or even 3%, that blue line just climbs beautifully. It goes from 58% to over 72% into the 80s, and eventually, on the far right, it hits a perfect 100% accuracy. I mean, looking at the blue line alone, it looks like the holy grail of trading. But look at what's happening to the pink bars. They are fading away into nothingness.
That perfect 100% accuracy, it was only achieved on exactly 3 tiny days out of a massive 800-day test window. When the threshold hit 3.5%, the usable sample size just completely collapsed down to 3 observations. This right here is what the author means by sample size accounting. That 100% accuracy is real data, yes, but it's a statistical mirage. Apparent high-accuracy regions in financial machine learning are almost always driven by a rapidly shrinking number of actual events. You simply cannot build a deployable daily trading strategy when your AI is only confident enough to trade 3 times over the course of more than 2 years.
And, this dynamic is even more extreme if we look at other targets. Here, we're looking at the exact same type of charts, but instead of predicting the market's close, the AI is trying to predict the intraday high on the left and the intraday low on the right. Notice how those blue accuracy lines shoot up to 100% way faster, and they just stay flat across the top. The models are remarkably good at guessing if the highest or lowest point of the day will be above yesterday's target. However, as the paper strongly warns, these are just statistical targets. To actually trade on an intraday high or low, you need to know exactly what time of day that price hit, which this model absolutely does not tell you. Plus, just like we saw before, look at those pink bars. They collapse again. High accuracy constantly demands low sample sizes.
So how exactly is the AI coming up with these predictions in the first place? Let's open up the black box in Section 5, inside the AI brain.
The cool thing is, we don't have to treat machine learning like it's some sort of magic. The researcher used a metric called SHAT values to measure exactly which pieces of historical data the XGBoost model prioritized the absolute most. This chart right here shows the feature importance for predicting the market close. See that absolute biggest bar at the top? That's VAR1T. What is that? It is simply today's opening price. The AI heavily relies on the very first piece of data it gets that morning. The next most important feature is yesterday's close, then yesterday's open, and so on. Basically, the older the data gets, the less the AI cares about it. This is great because it proves the AI isn't doing anything magical. It's logically deciding that the most recent price information is obviously the most relevant for predicting a same-day move.
And we see this exact same logic when the AI predicts those intraday highs and lows. On the left is the brain scan for the high target, and on the right is for the low target. In both cases, that top bar, VAR1 of T, today's open price, just completely dominates the decision-making process. Across all metrics, the AI is highly focused on the immediate present. Which brings us nicely to our final section, Part 6, the bottom line. This is where we separate the statistical reality from the trading myth.
Now, if you took these AI predictions and ran them through a basic backtest simulation, the results look incredibly tempting. The blue line here illustrates an XGBoost long and flat strategy, which even factors in a 10 basis point transaction cost. Compare that to the orange dash line, which is just a standard buy and hold approach for the SPY ETF. The AI strategy clearly outperforms right. It avoids those massive drawdowns in the middle of the chart and climbs pretty steadily. But, and this is a massive but, the author of the paper provides a very stern warning about reading too much into this single isolated chart.
Look at what the author explicitly states. The statistical benchmark is stronger than any economic claim. The paper intentionally avoids claiming that the present evidence by itself establishes a deployable strategy. It is absolutely crucial to maintain total objectivity here. A real-world trading scenario involves complex execution timing, slippage, and market impact that this simple same-day simulation just cannot account for. The signal is statistically detectable, sure, but translating that into reliable, executable economic profit, that is a completely different beast.
So what should you actually take away from all this data? First, the signal is real. Simple daily features really do contain detectable information about same-day market direction, with simpler models like Logistic Regression actually shining the brightest. Second, always watch out for the high-accuracy catch. If someone online shows you an algorithm with 90% accuracy, demand to see the sample size because it's almost certainly collapsing down to just a handful of usable days. And third,
While this is a beautiful demonstration of statistical finance, it is fundamentally not a deployable trading strategy out of the box.
Predicting daily stock direction is incredibly hard. It's not entirely featureless, but those signals are fleeting. So, knowing that the most impressive algorithmic accuracies are often just statistical mirages born from shrinking sample sizes, we have to ask ourselves, is the quest for perfect algorithmic trading really worth the risk, or are we better off acknowledging the limits of our machines? Thank you so much for joining me on today's deep dive. Keep questioning the data and keep learning. Catch you next time.